just now. Let's take our conversation forward. Last time when we met with him, markets were down, he was smiling. And today his portfolio has gone up, so he's smiling more. Am I right?
And wearing a green shirt.
No, it's reflection, I think. Is it a green shirt, Nilesh?
Yes, it is.
My God.
It is
Age
a
is catching
nice
up.
subtle green.
Age is catching up.
It's a
Age is
pastel
catching up.
green.
I thought it was some other color. Age is catching up. But you don't need to wear green. Markets are in green. It's okay, Nilesh. See, I'm supporting the cautious color by being red.
The markets are in green or not, you remain green.
Nilesh, whatever could go wrong has gone wrong for us a month ago. There was a macro crisis, there was an inflation scare, crude was on a boil, commodity prices were at elevated levels, everybody was worried about inflation. Today everything is working for us. Crude has reversed, FIs have stopped selling, earnings have been okay. So what's next from here? From a messy situation exactly a month ago, where it just felt like a terrible time to be an equity investor, now things are really roaring up. What a difference sometimes 4 weeks can make.
Yeah, absolutely, Nikunj, and good to be on this show, Nikunj. If we had probably had this conversation just probably about 6 months back, or maybe at the start of the calendar year, and if we had probably correctly we predicted that all the challenges that we have seen in the last 6 to 7 months, if we had even correctly forecasted these kind of challenges or predicted these kind of things to happen, we would have probably thought that the market would be down a lot more. If we had correctly said if crude was going to go to 130, 140, and if there was going to be a war between Russia, Ukraine, and all of that, and there's going to be so much of FPI selling, the markets would have been down. We would have probably come to a conclusion markets would be down a lot more. But versus that, we are probably just off 10% from the highs of October 21, maybe 10 to 12%, which itself is quite remarkable. So what it looks like is that this weakness has been used as an opportunity, essentially by long-term investors to essentially buy in and keep building their portfolio and adding to their positions. And pretty much exactly even a month back, maybe the kind of environment which was there, one would have thought that it would get a lot more messier before it turns rosier. But that's how markets and sentiment are. What it looks from here and is clearly one thing, that the macros have been in a way managed relatively better. We have an environment where our inflation rate is lower than what it is in developed economies. The depreciation in the rupee is a lot less versus the depreciation that we've seen for developed market currencies like that of Japan or Euro or UK. So on the whole, it looks relatively a lot better than what we could have even imagined. So to that extent, I think that's quite enthusing. And from here going forward, what the street is going to watch out for, or what everybody's going to really watch out for, is how do earnings play out, because this is surely going to be a challenging year in terms of earnings. And if the earnings don't go as bad as what maybe some of the macroeconomic variables have changed, I think we should be fine. I think India as a market should be pretty fine than what we are seeing the world over.
Right. ITC have to take a slight bit of detour. It's finally made it to 300. Nilesh, 6 months back, no one would look at this one, and look what it's done in just such a short span. It's already at a 52-week high, made it to 300.
Oh yeah, I mean it's been a huge outperformer, and that's the way at times some of these kind of bellwether stocks, they perform, that they don't do anything for maybe 5 to 8 years, and then suddenly in a couple of quarters they kind of report a very, very high amount of outperformance. But I still think that this appreciation in the stock price has little to do with the underlying growth of the businesses. The underlying growth of the businesses probably still is in single digit. but it's all about expectations of corporate actions, that there would be demerger of various businesses, and all of that. So it's those kind of expectations which I guess is basically helping the stock price to hold up and do better, and in fact rise in a market which is down year to date. So it's all about that. You could of course describe this to more of margin of safety and all of that, and maybe their margins will not get as impacted as what you would think for some of the larger FMCG companies. So I wouldn't want to read anything beyond that. It's like a stock you own, and then you hope that the corporate actions in terms of demergers and all of that, or value unlocking, happens as soon as possible.
Right. Nilesh, you track IT closely, so I have to ask you, I mean, what's going on here? TCS was a bit of a disappointment. I can say the same about HCL Technologies. Wipro seems like a disaster. Having said that, the price collapse has happened very swiftly in just the last week, and now these stocks are rebounding. How do you treat IT now? Do you think the heydays are way behind us? Are you now playing it for a, just trading momentum or a rebound? Or would you say that IT will recover and this is the time to, start buying again?
IT, there are two sides to IT, and there are two sides to the coin here. One is essentially the business momentum and the growth and the market opportunity for Indian IT services companies, and that I think is very, very much intact. If at all, the size of the opportunity and the ability of Indian IT companies and the value proposition which they have to offer is surely becoming a lot more compelling than what it was a year back or even a decade back. So to that extent, I have no doubt in terms of the potential and the business momentum, and that's, I think, here to stay from a multi-year horizon, and I remain as excited on IT as I have been. The other side of the coin is the margins, and what it looks like is that the margins that we saw in calendar year 21 or financial year 21-22, those probably are the best of margins that we have seen. I don't think the margins are going to get any better than that. If at all, we have to deal with an environment that the margins will be lower than the peak margins that we saw in FY 21-22. And therefore, it's quite possible that 1 year forward, the net earnings growth could be a lot more muted than maybe what the revenue growth is going to be. So we're going to be in a situation where for the next 1 year or so, maybe IT as a sector may not deliver the kind of returns, or it may not be able to outperform. But I would look at that as an opportunity to kind of find value in some of the established name, or find opportunity in some of the lesser tracked names. That's the way I would really kind of look at it. So I would clearly use this as basically a buy on dip strategy, accumulate on dips kind of a strategy in IT, with not have any material expectations over the next 1 year or so. But I think post that, it should be back to business for IT companies, and I expect that then the sector to start its outperformance.
Nilesh, so do you think the second half of this year could be distinctly better? Things are falling in line for us, whether it is on the earnings front or on the commodity front, and even on the flow front now.
Oh, absolutely. What it looks like is that maybe we would clearly see all these concerns, challenges, and all of that peaking out maybe in the first half of this financial year, or at best by the end of this calendar year. So I do expect the markets to clearly bottom out between, say, now and December. And that's because I expect some of these challenges to kind of in a way peak out. And even if the challenges do not peak out, but I'm quite sure that a lot of policy action would be taken, anticipating that it might get a bit more worse, and also the fact that maybe the markets itself may factor in all of those impending negatives which might be there on an incremental basis. So it's quite possible that we may come down to levels where things become so attractive from a medium term point of view that markets may bottom out. And along with that, what we may see then is basically a case where interest rates may start to kind of in a way plateau or fall, FPIs, instead of selling, start buying, and of course earnings growth comes back. Once earnings growth comes back in double digits, you're really going to see the markets surely bottom out before that happening, and then of course the market continuing to inch up. So I think CY22 is essentially a year where expect things to bottom out, and then of course from there onwards, CY23 and FY24 is basically, I do expect the markets to start its upward journey and the bull market to kind of proceed ahead.
Okay, so this is the year you're expecting to be your markets bottoming out, and next year for the bull year picking up. So Nilesh, from the recent lows that we had, can I ask you, how did you use that opportunity? What did you buy? For example, you were making a compelling case for IT. TCS was available for less than 3,000 rupees a share last week. But across sectors, what were some of the top picks and buys?
So we've used the recent corrections to add to our positions in technology services. I think we have been relatively underweight, but we've used these dips to buy into them. We've added new positions on the capex front. We clearly believe that the business momentum is the strongest on the capex side. So we've used this correction to add into capex positions. And then of course defense is one area where we're clearly seeing a very, very strong case for indigenization of defense procurement, and we're seeing several players out there being able to participate in that, and therefore we think that from a medium term perspective there's a good amount of opportunity in defense. So clearly I think it's been around adding to our existing positions in technology, some new positions both in capex and defense. And then of course there's been the insurance pack and some of the financials which had of course corrected sometime between April to June, and we've used these dips to buy into them as well.
So how did you exactly play the capex upcycle? Are you doing it with banks? Are you doing it with the companies that are announcing major capex plans from steel to cement to textiles?
Well, we kind of the most constructive on the companies which are supplying either equipments or components, to basically either machinery manufacturers or people who are in a way expanding capacity and therefore incurring capex. So we are looking at companies which are essentially supplying equipment, supplying components, supplying integrated systems to companies who are incurring the capex. So that's the way we are playing it. We're not yet playing on the wholesale side of banks. We're not yet doing that. In banks, we are more focused on companies which are more on retail lending versus wholesale lending. And of course, we're not in any meaningful way into commodities or like steel. We don't have any positions in steel. And even in cement, it's like a very, very insignificant on our minor position. So yes, we're playing it through the equipment and the component guys.
Your top three holdings on 1st of Jan 2022 versus 21st of July 2022. Have your top three holdings changed? Because the world has changed, my friend.
I don't think they have changed materially, except for basically the weights going up or down because of outperformance or underperformance. So I don't think they have they have changed in any material manner. The pecking order could have changed because of relative performance of individual positions. So basically in our large cap portfolio or in our multi-cap portfolio, in our multi-cap PMS, Mahindra, which was probably not a top 5 position, has become like say a number 1 position or a number 2 position because of the sheer outperformance it has had. Or Hitachi Energy, for example, which was not amongst say our top 2 or 3 positions, has become at least in our top 5 positions because of the kind of outperformance it has demonstrated. But otherwise, I don't think have we sold meaningfully into any of our top positions. I don't think so. We continue to our top position used to be in technology, which is LTTS. We continue to still own it. Our top positions, amongst our top positions used to be Radico Khaitan as well as United Spirits. we continue to own these positions because we like the long-term structural opportunity that they are addressing.
Nilesh, that's quite interesting. And we all know the way Hitachi Energy kind of names have actually performed in the last 1 year or so. But is this now part of your long-term holding, or is there some watch list that I'm going to make so much return and then maybe get out?
Specifically around Hitachi Energy, we like the long-term opportunity that they're addressing. I think there's a huge potential for Hitachi Energy to expand margins going forward, but it's just that the sheer outperformance which the stock has demonstrated, because of which we have in a way taken some money off the table. That's like more of managing your weight rather than having a negative view or anything like that on the stock. But I still believe that the best is yet to come, and when the earnings momentum is very, very strong, it inevitably leads to basically huge amount of outperformance of the stock. So in maybe short to medium term, markets do tend to kind of in a way overlook the kind of high P multiples and all of that, as long as there is earnings momentum to support it. So while we have taken some money off the table, but we like positions like Hitachi Energy just because of the fact that we are yet to kind of get into a full-fledged capex cycle. Great early signs of a capex cycle, but I still think it's got a long way to go. It seems to be a multi-year opportunity. And then of course, when there is strong business momentum, it also leads to margin expansion, and therefore the earnings growth can be in kind of a double-digit kind of earnings growth. So we like these kind of opportunities and like to be positive, even despite the fact that yes, there has been a very, very strong outperformance.
Nilesh, we've interacted for almost 2 decades now, personally and professionally, and what I've known of you is that you are a value investor and you like to buy growth companies at a decent price. Now, if I look at the holdings which you just mentioned, LTTIS, it is growing, but it is currently at a P multiple which is higher than that of market leader TCS. Hitachi, it is a good business, but the P multiple is higher than that of ABB and Siemens and L&T market leaders. Radico Khaitan, good company, but the P multiple is higher than that of, let's say, USL. Why are you buying these mid-cap stocks when the leaders are available at cheaper?
Purely because, Nikunj, that's a great observation and a very interesting question, and I think it's something which it's an issue that we kind of grapple with pretty frequently and very regularly, and you're right. But I think the bottom line is that these are companies which, in a way, have a very differentiated growth strategy. They're able to report better growth, and going forward, also the potential for growth out there is quite kind of significant. And so let's look at it like, say for example, LTTS. Obviously, of course, we've been now owning it for a very long period of time. But the kind of services that they provide, which is around engineering-led technology services, I think is relatively unmatched. I'm not saying that they're the only players who do this, but I think what they do, I think they are well recognized for what they do, especially because of the pedigree that they have. Now, they have guided in the conference call that this year, they will be exiting this year at $1 billion revenue run rate, and they will be exiting FY25 at a run rate of $1.5 billion. That's like kind of a 50% increase in revenues in a 2-year time frame, FY23 to FY25. I'm not quite sure if there are too many IT companies out there, and certainly it looks less likely that TCS is going to increase its business or report a 50% growth in revenues over the next 2 years. Okay, this might be an aspiration, it may not be a guidance, but nevertheless, it is what it is. Now that's something which I think is you don't come across these kind of things too often. Similarly, I think in the case of Radico Khaitan, you're right, valuations are not cheap, but of course valuations out there are huge discount to the leaders out there. Maybe United Spirits trades, and we own United Spirits as well, trades at maybe 80, 90, 100 P multiple. Radico probably trades at 35, 40 P multiple on trailing earnings basis. So there, of course, it trades at a discount, and obviously they have a premiumization strategy which is helping them to grow at a higher pace, have better margins, and have higher cash flows. So I think the structural kind of opportunity is still pretty much intact, and I think these companies are doing something differentiated which is helping them to grow at a faster pace, and therefore we think that they basically deserve the valuations which they get. In terms of the overall portfolio strategy, it's not just these growth-oriented kind of businesses, but we also own a few what you would classify them as value stocks. So I think
Nilesh,
some of
I
the
look at
smaller
it this way.
positions like TV Today, Pratap Snacks, these are some of the smaller companies,
So Nilesh, I look at your portfolio.
which of course you could call them as value plays.
So Nilesh, I look at your portfolio. You own a liquor company, then you own a snack company, then you own a holiday company. Bhai, kya ho raha hai? What are you betting on?
The good times.
I thought you were a technology true blue,
Yeah, I mean,
high
as the
growth
adage is,
investor.
right, that-
You're going back to chakna companies, snack companies, liquor companies, holiday companies. What will happen to your reputation as a technology guru?
Well, as you. No, Nikunj, as they say, like at times people take investing too seriously, life too seriously. The best way to add color to it and make it more fun-filled is to kind of basically ensure you have a portfolio of positions which are into kind of businesses which make life very, very interesting and entertaining. So yeah.
Come on, ET now. If that was not enough. So very green and come on, ET now, right?
Yeah, but Nikunj, I think apart from technology, I think I think a lot of these businesses, I think Indians are going to consume much more of all of these things going forward, and therefore these businesses seem to be really well placed and well poised for India's long-term growth potential. So yeah, that's the way I look at it.
Okay, Nilesh Shah, thank you so much for joining us today. And next time, hopefully, you'll be in the studio with Nikunj and Aisha in Mumbai. Thanks a lot for joining us today with your strategy. And I like the way you're adding color to your portfolio as well.